Hello, everyone. Welcome back to Navalier Market Buzz, episode 25. I'm Crystal Navalier, and I'm joined again this week with my father, Louis Navalier, and of course, Jason Bodner, who is the co-founder of Map Signals. Welcome back, everyone. If you didn't get a chance to watch our latest videos, it's earning announcement season, and each week, Louis and Jason will be discussing a new round of stocks for their earning announcement. Currently, we're in the seventh inning of the earning announcement season, but we still have some stocks that we need to talk about. So let's start out with Medtronic Place.
Well, this, of course, is a medical device company. They make a lot of cardiovascular devices, and their sales are supposed to be up 2.9%. Earnings are only supposed to be up 4.6. The analyst community is pretty quiet on this stock. It does have a good surprise history, but again, it's a medical device company. So uh, these stocks are kind of boring, to put it bluntly.
Yeah, I think you just hit on it. It has that strong surprise history. That's what I like about Medtronic. From a sales and earnings perspective, I mean, this stock ranks well in my system. We have good one-year sales growth, but negative one-year earnings growth. So I'm going to be looking to see, if we beat earnings there, it's a little more meaningful. They have a nice profit margin, good estimated sales and earnings growth for next year, which is really nice. Overall, the company is good in terms of everything. It's got a little bit of debt, but in a falling rate environment, that's fine. Really, it comes down to me to the earnings beat and, as always, forward-looking guidance.
Now, for Expeditors International Washington, I'm not sure we can expect good things.
Believe it or not, these guys are the logistics company for the shipping industry. So you can uh, track a container from China to a boat, to a port, to a truck, to its ultimate destination. They coordinate every step. So what they do is very important, and their sales are supposed to be up 23.3% because everybody was dumping goods trying to get ahead of the tariffs. So that's good for them. The earnings are supposed to be up 31.6. The analysts have revised their estimates slightly higher. But as you mentioned, Crystal, tariffs are coming, and that might affect trade. And so long term, there's a cloud hanging over this company. But we're still going to be trading with or without tariffs. So, but right now, I'm expecting a nice surprise because the analysts have revised their estimates higher, and it looks like they front loaded the shipping this last holiday season.
Yeah, Expeditors has a mixed earnings report. They beat, then they missed, then they beat. This stock is just kind of middle of the road in terms of my system. It's near 52-week lows, technically speaking. It's been range bound for the better part of the year. In terms of why it gets a 46 in my system, it has decent fundamentals, but the 1 year we're looking at very negative sales growth, very negative earnings growth, 46 and 39% respectively for 1 year. That's not great. The 3-year trend is a little better. It's positive. It makes a nice profit margin, but estimated earnings growth for next year is down 2%. So I think the good news about EXPD is because it's technically weak and there are a lot of headwinds priced into the news, all they have to do is beat and have a little bit of positive guidance, and you'll see positive things for this stock. But overall, I'm not too excited about it.
Do you expect something similar for Cadence Design Systems?
Well, this is an integrated circuit company, and obviously they're benefiting from the semiconductor industry heating up. Their sales are forecast to be up 26%, so that's pretty strong. Their earnings are forecast to be up 32.1%. Anytime earnings grow faster than sales, the margins are expanding. The analyst committee has been quiet, but this stock does have a good earnings surprise history. So I would expect another surprise and then be lifted by the overall tech sector.
Yeah, this is an interesting one. It's sort of a prior darling in Wall Street. It ranked, sort of middle third for my system, 62, but it's really punished by its technicals, not its fundamentals. Fundamentally is a very strong stock. We're talking 15% sales growth 1 year, 23% earnings growth, and strong double-digit percent for 3 years as well. It makes a 25% profit margin, and it's slated to grow sales and earnings in the double-digit percent for the full year. Plenty of key free cash flow. On paper, looks like a monster. It's just technically suppressed right now and sort of, like I said, range bound. This one has another strong history of beating. It's not by a mile, but they tend to beat estimates. So I think this one is all about their forward, because even if they just come in line, the stock's not really going to go anywhere. But if they come out with really rosy guidance, this thing is going to reprice significantly higher. If it comes out with negative guidance, it's sort of already in the muck. So I think there's more upside to this stock than downside.
While we're talking about software companies, what do you think about Arista Networks?
Well, this company's benefiting from the expansion of the cloud. That's what they do. They provide cloud computing solutions. And their sales are supposed to be up 23.7%. Earnings are only supposed to be up 9.7, so they do have some margin compression. Again, anytime earnings don't grow as fast as sales, margins are under temporary compression. But the analyst community is very quiet on this stock. It has a very good earnings to price history. I would expect, because of Supermicro's guidance past week, and the fact that Supermicro, NVIDIA, and other stocks are rallying, I think it's probably going to beat and go higher. It's not one of my stocks, though, because the margins are under compression.
Interesting. This is where we diverge a little bit. I agree with everything you just said. This stock ranks very high in my system, 84.5. It's something we've held now for the better part of a year, maybe. We're up about 140% on it. They're a wide area network switcher. They manufacture hardware, so, optimized for cloud applications. So, their products are very in demand. They boast, the biggest companies out there like Google and Meta as their clients. Massive 1 and 3 year sales growth, huge profit margin, 36%. Even with that compression, it's a super healthy business. They have almost $2 billion cash laying around, and they're slated to grow sales and earnings next year, earnings by 12.5% for the full year and 19.4%. So, this has been a really top performer. It's top ranked. It's sort of number one in the sector of hardware, and it's amongst my favorite stocks, certainly for large cap.
Now, I love Etsy, but I'm worried what you're going to say about them.
Their sales are supposed to be up 2.3. Their earnings are supposed to be up 20.3. The analysts have trimmed estimates just a tad, but I guess if there's any problem with Etsy, it sells a lot of goods online, is they always miss on earnings estimates. They missed the last 3 quarters in a row. And it's really hard to be rewarded by Wall Street when you can't meet their expectations. So for their sake, I hope they beat, but they haven't passed 3 quarters. So that's why I don't own this stock.
Yeah, Etsy is one of those stocks I've owned for a while. I wrote it significantly higher and then paid the price later. It was a massive grower, a huge company. Obviously, they benefited tremendously as well from COVID, selling all sorts of online crafts and sort of more home items, even though they're not really. This stock right now, first of all, I should mention, it's up 5% today. Something is pushing it higher. I haven't really looked at the news, but this stock ranks a 51 in my system. Fundamentals are 62.5, which is good. Technically, it's very weak. Again, near 52-week lows, kind of bouncing off the bottom there. That is a great setup for any sort of surprise, especially Louis, like you said, they missed 3 in a row. If they surprise here, offer any positive guidance, this is one of those that can gap up 20% easily because there's so much negativity priced in. Sales and earnings growth is great, except for 3-year earnings growth is really negative, and they're slated to grow next year. Sales, like you said, 2.3 for the full year. I like to see more. So I'd love to see sort of positive momentum on the fundamental side, and that could really get this stock going.
Now, I'd love to know what your thoughts are on the housing market. Is it up? Is it down? And also, how might that contribute to Toll Brothers?
Well, the bottom line is the housing market in America is two-tiered. Okay. So if you go to what we call normal suburbia, prices are being cut. Okay. That's because mortgage rates are high and people have a hard time affording the homes. If you get to the higher end, it's doing fine. And that's where Toll Brothers operates. And that's why I own the stock. It's in our managed accounts, and I've recommended it for some time. Crystal, you may be aware that Bridges Development in Rancho Santa Fe, that's a Toll Brothers development. Okay. And that's an example of how they cater to high-end home builders and all, and high-end communities especially, because they built the golf course and all the facilities there. Now, believe it or not, their sales are supposed to be down 1.8%. Their earnings are supposed to be down 8.7%. So why would I own a stock with negative sales and earnings? And the answer is because they have huge earning surprises. And also we have a president that's going to promote housing. And you have to make housing grow to get the manufacturing sector growing. There's a lot of durable goods that go into homes. So just like he showed up in Pacific Palisades and was demanding that they start building immediately. And he has a different view of the world than the locals did, where they weren't going to let anybody build for 18 months. So I do want to hold one home builder, and Toll is the one I want to own. And of course, a lot of their homes are sold for cash, so they're immune from the mortgage problems.
I really like home builders in general. Toll is a great one. It currently scores a 53.4, but again, a great setup. I like setups like these that are technically weak, fundamentally strong. I mean, this company has great 1 and 3 year sales growth, historical, operated a nice 14% profit margin. They're slated to grow earnings for the full year 10.5%, sales 7.3%. They have almost $1 billion cash on hand. The stock's up 157% in 5 years, and we're sort of at the lower end of the range in terms of its 52-week price range right now. I think a key thing you just mentioned, Louis, is we have a president who's committed to, obviously America and all that stuff, but he's a real estate guy. He likes real estate. His own personal wealth was built on real estate. It will probably continue to be. He's committed to the sector. He is vocal about putting pressure on the Fed to lower interest rates, which would spur home buying in general, which would lift the market, even though Toll is luxury and has a lot to do with cash sales. But, I see future tailwinds for the housing industry. And Toll is a leader.
Absolutely. If he wants to redevelop Gaza, trust me, he wants to redevelop America. And
Yeah.
it's a huge driver of GDP growth. It's a huge way that people accumulate wealth. That's why the baby boomers have disposable income from their homes.
Now, when it comes to energy, what do you expect for Devon Corporation?
Okay, Devon is a natural gas stock. It yields 4.24%. It is going to benefit from drill baby drill, because drill baby drill from the Trump administration is going to boost our natural gas supply and our LNG exports and our natural gas usage, mostly through natural gas peaker power plants to fuel the data centers. And we have to double the electric grid, and natural gas is the easiest way to do it. But in the interim, Devon is basically subject to the weather. So if you buy Devon Energy, you want to root for very cold, miserable winters in populated areas. So if it gets cold in the Rockies, that's not enough. It's got to get cold in Chicago, New York, DC, Boston, populated areas, and some hopefully the deep south as well. And then the natural gas usage explodes. And then during the summertime, you want hot, miserable summers because then the natural gas peaker power plants will come on to generate electricity for air conditioning demand. So if you buy this stock, just be aware of that anomaly. And you might want to look at the Farmer's Almanac more than listen to me or Jason on this. But I will tell you their sales are supposed to be up 2.5%. Earnings are supposed to be down about 29, but Biden was suppressing LNG and natural gas, and now Trump is promoting it. So this is a very this stock should do very well long term, but again, it's totally dependent upon the weather.
Yeah, interesting take. Again, I like this setup from a short-term investing or trading standpoint, not necessarily a long-term investment, because I tend to buy into strength in terms of its fundamentals and also price. I like momentum on multiple levels in terms of fundamentals and technicals. And right now, negative 1 year sales growth of 41%, negative 1 year earnings growth. Negative 1 year sales growth of 24%. Negative 1 year earnings growth of 72% is not what I look for. They have a strong 3 year track record for sales and earnings growth, strong profit margin. None of those things bother me, but I like to see sort of near-term path clearing for an investment. But from a trade standpoint, this stock is down near 52-week lows again. They have a strong history of beating earnings. And if they beat here, the stock's range is, it was trading at around, what was this? $55 in April, and it's $34, just near the 52-week low. So all they have to do, have some positive comments, something, and with all the negativity of the price, negativity priced into the share price, we could see some serious upward momentum. And, pile in any shorts that have to cover, that could be a nice pop in the stock. So I see more upside than downside, but from an investment standpoint, meh.
Keeping in the realm of commodities, what do you think of CF Industries?
Well, this is a fertilizer company, mostly nitrogen fertilizer, and their sales are supposed to be down 4.5%. Their earnings are supposed to be down 4.3%. They have surprised in the past 2 quarters. The issue with these fertilizer companies is they usually have 2 blowout quarters, once a year, and then 2 weak quarters because it's tied to the planting season. And the analysts have trimmed their estimates just a tad for the stock. But this was a company that was suppressed not only by the Biden administration, because they suppressed natural gas and all, where you get your nitrogen fertilizer, but it was also suppressed by the Paris Climate Accord because they wanted everybody to go to organic fertilizer versus chemical fertilizer like CF Industries makes. So, so if you're using phosphate or nitrogen, that's a chemical fertilizer. Organic fertilizers, what the Paris Climate Accord was pushing. The problem is organic fertilizer isn't as productive, okay, and won't get your yields up as much. So the U.S. is predominantly a chemical fertilizer country. So is Brazil and a lot of other places. In fact, they have to use these strong fertilizers in Brazil because the soil there is very sandy, doesn't hold the nutrients. So if they don't pour fertilizer on it, it doesn't grow very good. And but the big issue has been Europe. And that's why you had all the farmers protesting because they were forcing them to use organic versus chemical. And of course, natural gas is very expensive over there in Europe. So that's another reason they might not have been using it. So, but this should prosper under Trump, and we'll see. But near term, I hope they beat again, and I hope they prosper from the natural gas boom.
This is another interesting one, like Devon Energy, where the horizon looks potentially brighter for these companies for all the reasons you just mentioned. Biden suppressing natural gas, Biden suppressing chemical fertilizers, Europe wanting to go organic, all those things. If these things shift, that could sizably change the outlook of these companies. Anecdotally, we bought a couple of plants for a party I had in the house, and then a couple of weeks later, I don't really have a green thumb. A couple of weeks later, they looked droopy. For the first time in my life, I bought some Miracle Grow. I don't think it's a CF Industries product, but it is full of chemicals. And I got to tell you, that stuff works magically. And the truth is, plants, they eat the chemicals that we don't, right? They survive on carbon dioxide, all that stuff. So, the question of whether or not this is environmentally impactful with a new administration seems less and less of a current concern. So that could be good. But like you said, Louis, they missed first quarter. They beat the next two quarters. So they have that cycle. This is a company that scores 58 in my system. Fundamentals are stronger than technicals, but still significant 1 year sales and earnings growth is negative, 41 and 52% down respectively. 3 year sales and earnings growth is 30% and 141%. So it's kind of volatile with its growth history, and it's sort of reflected in its share price as well. They do make a very nice profit margin, slated to shrink earnings 9.2% for the full year and grow earnings grow sales 1.2%. So if we get a boost in that sales outlook, you could really see some upside for the stock. But overall, it's a middle of the road stock for me, and I would like to see more sales growth in terms of guidance for the full year.
I know we all love Walmart, so hopefully we can expect good things.
Yeah, this was added to our managed accounts recently, a pretty big allocation too. Their sales are supposed to be up 4%. Their earnings are supposed to be up 7.7%. The analyst community has been quiet on the stock, but their same-store sales growth is impressive. Their online sales are impressive. Their grocery sales are extremely impressive. Every Walmart is like 5 stores in one, and they have specific managers running various divisions. It's very well managed. Times are tough and people are upset with higher food prices. And so you're getting much more upscale shoppers going to Walmart to buy their groceries. So I'm expecting a big surprise. And again, I own it in portfolios and recommend it in newsletters.
So Walmart, we agree here. This is one of the highest scoring stocks we're talking about today, second only to Arista Networks. This one scores a 75.9. Everybody knows what Walmart does. Very strong technicals. Look at that 1 year chart. It is just straight up and to the right. Terrific. Fundamentals are 58.3. And that's not because it's a bad company. It's because my system rewards double-digit sales and earnings growth. That's really, really hard to achieve when you're a company the size of, Walmart, $840 billion. So they grew sales 6% last year. That's still pretty good for a company that size. Earnings growth was 34%. They're slated to grow sales and earnings next year. Earnings by 11%, sales by 4.2%. They eke out a 2% profit margin, but Walmart is the very definition of high volume, low margin business. And they're sitting on $15 billion of free cash flow. So I really like Walmart, where it is, how it's positioned. If inflation remains to be sticky, this is a beneficiary, obviously. And like Louis just said, if you see higher end people starting to shop at Walmart, that means they're going to buy more items with better margins than their usual customer base. So I really like Walmart all around as a sound company. There tend to be huge reactions around Walmart, Target, Costco, the big box retailers and wholesalers. So it'll be really interesting to see what the reaction is based on their forward statements, because it's really sort of crucial what a behemoth like that has to say about their outlook.
Yeah, and I would add that Walmart used to have a paycheck cycle, so their sales are stronger in the beginning of the month and mid-month when people's paychecks came out. They don't have that paycheck cycle anymore.
Mhm.
That's because more affluent consumers are shopping there. So they've gone upscale, and of course everybody likes a good deal. And that's why everybody's at Costco too. Costco sells to upscale affluent households, and we own that one too, of course.
In terms of electric and gas, what can we expect from Quanta Services?
Well, I've owned this stock for a long time. It's been in managed accounts for a couple of years, and it's been recommended in our newsletters. Their sales are supposed to be up 14.2%. Their earnings are supposed to be up 28.5%, 28.5%. Analyst community has been quiet, but this is a company that helps utilities build their infrastructure. Obviously, we have to double the power grid. They do everything. They help with all the alternative energy. They help with the traditional natural gas and coal-fired energy. And so a good example is like in Pacific Palisades. I hope they're going to bury all the power lines now because you do not want your power on a pole with a big can full of oil. Okay, and that's why when the winds come up, those things fall down and they start the fires. And so hopefully they'll help them bury all the power lines in Los Angeles to suppress a fire. And but again, we're doubling our power grid in America to fuel AI, and so this company can't help but benefit.
Yeah, this is one where we get a 58.6 rating. So why is that? Technicals, it's a 53. That's because it's sort of sold off hard from its high, and it's kind of been range bound ever since. It's in the middle of the range for the year, which was showing, a strong uptrend for much of the year through to November, where it peaked and sort of leveled off. The real juice here is in the fundamentals. You're talking about 1 year sales growth of 22%, 1 year earnings growth of 50%. 3 year sales and earnings growth, strong double digit, near 20% for each. Their profit margin is a little low, 4%, but again, higher volume business. They're estimated to grow earnings 18% and sales 12.9% next year. So, for a $43 billion company, there's still a lot of growth left. So I'm really interested to see what's going to happen. This stock is down 8% year to date, down 7.4% in 1 month. So again, any sort of positive surprise, which they have a strong history. They beat sales and earnings. They beat earnings the past 3 quarters, and they've been growing revenues each quarter successively this year. So if that trend stays in track, they have positive comments. I see upside for this stock more than downside.
And finally, let's talk about Rivian Automotive.
Well, this is very interesting because obviously this is a success story. You just go on the road and you see all the Rivian trucks driving around. Their sales are supposed to be up 8.4%. Their operating earnings are supposed to be at 52.5, but their overall earnings are going to be down. But analysts have been raising their estimates just slightly, but again, they're going to have overall earnings down. I think the big story with Rivian is its alliance with Volkswagen. Volkswagen has pledged to put $5 billion into this company. They got immediate access to their software that they use in the vehicles, their interface. And the Volkswagen's trying to team up Rivian with Scout Motors. So I should explain what's going on. Scott Kehoe is the head of Scout Motors. Now, he ran Audi in America, North America, and Volkswagen North America. Scout Motors is finishing its facility in South Carolina, and it's somewhat controversial because they want to go with a direct sales model, just like Tesla. And Rivian does have a direct sales model as well. So these two companies have some synergies. The Scout truck that's being built is on a ladder frame, just like the Rivians, and they also are coming with a generator for a range extender. So I think the Scout Rivian alliance is very, very good for this company long term. They can clearly help each other, but it's it's like anything. It's you got to get interest rates down so the vehicles sell a little bit better. And but they have the might of Volkswagen behind them now.
Yeah, interesting. Really interesting story on Rivian. But from my perspective, it's a story stock because I'm looking for solid fundamentals, solid technicals. From a technical perspective, this stock is down 12% over the past 12 months. The chart looks really sort of sloppy and sideways, not much to be excited about. We had a huge peak in July where the stock was trading at around 17 and a half. It's now near 13 bucks, 13 and a half bucks. Why don't I love it? Well, they did miss earnings the first two quarters. They beat last quarter. The big story for me is that they're not profitable. And I know startup car companies are probably going to lose money for a while, and they have the might of Volkswagen behind them. But in a sea of thousands of stocks, I like to pick the best of the best, as do you, Louis. You always say creme de la creme. They do have strong sales and earnings growth, which is great, but they lose money hand over fist because they're still trying to gain market share in the EV market, which is murky at best right now. And they're estimated for 1 year sales growth, earnings growth to be negative 32%. So, for me personally, it's all about the story of where their growth trajectory is towards reaching profitability, which could be years away. So this is all comments. I think the numbers that come out are almost immaterial because if they come out and say sales were down more than expected, but we secured XYZ contract and we forecast, you could see the stock go up because the fundamentals just aren't there right now to really back up the story. The story's a huge one, really interesting.
So now with all this being said, Jason, how is the earning announcement season going?
Yeah, I'm glad you asked that. As of what was it, last Friday? So I look at FactSet. They do a really great job of aggregating earnings, and they put out a piece called Earnings Insight, usually every Friday during earnings season. So this is a week ago, but as of that time, 62% of the S&P reported, S&P 500, and 77% of companies beat earnings. And 63% beat sales. Now, why that's interesting to me is, and we'll have a graphic here, is I've been tracking the 10-year average of companies beating sales and earnings. And generally speaking, on average, over the past 10 years, 74% of companies have beat earnings and 64% have beat sales. So, earnings are just rolling along, doing what they do normally, and we're getting nice beats and nice earnings and sales beats, which is great. So that just kind of points to one thing. Either the analyst community is really bad at their job, and they only get things right, 25 to 35% of the time. I don't think that's true. Or the whole game is kind of engineered to have positivity and optimism built into the market to entice investors to keep investing. I think analysts tend to be conservative. Companies know that. And like you mentioned on Etsy, they just keep missing earnings. Maybe they didn't get the memo. Great thing to do is beat sales and earnings. So we have that huge 10-year trend just humming along right in track right now, which bodes well for the growth of the economy and general economic data that everybody's worried about in terms of, some people are still talking recession. We're not getting a recession. It's clear in the earnings. So that's really encouraging from my perspective.
I would add that so far, sales are up 8.7% this quarter for the S&P. Earnings are up 16.4%. But the good earnings tend to come out early and bad earnings come out a little later. So that number could come down a bit. Although we still have NVIDIA. NVIDIA is the grand finale. And so this is so far a stunning earnings announcement season. We're going to have double-digit earnings all year long. And that's one of the reasons the market's going higher.
So now let's move on to subscriber questions. What are your thoughts on NVIDIA?
Well, NVIDIA's been boosted by a Supermicro Computer's guidance. Obviously, Supermicro buys the Blackwell chips, They go in the Supermicro rack systems. They go in the data centers. And Supermicro on Tuesday gave a very upbeat outlook that was well above analysts' expectations. Their near-term outlook wasn't as strong, but the longer-term outlook was phenomenal. And that's all anybody really cared about. And that's why Supermicro is leading that entire sector higher. And it's pulling NVIDIA with them. So both NVIDIA and Supermicro are lock and load, and those are our two top holdings right now.
Yeah, I think in terms of NVIDIA, we're talking about the biggest growth story in recent years. I mean, the stock's up 2,000% in 5 years, almost, call it 1,900. Massive triple-digit sales and earnings growth for 1 year, 3-year earnings growth at 218%. They have close to a 50% profit margin. So you talk about price perfection all the time, and I think you're right. But I think what is really fascinating to me is, remember 2 weeks ago when NVIDIA and AI market was done for because of DeepSeek? Well, that literally just vanished in thin air. And maybe we'll get a revisit to that news, but I think it's been largely discounted. And the reality has to set in that NVIDIA makes the best chips in the world and everybody wants them. And there's a backlog of orders. So, it's almost like no matter what they say, it's still a terrific investment because right now there's no better game in town.
Yeah, in episode 24 of Navler Buzz, Market Buzz, we discussed DeepSeek and why the initial conclusions on them are probably wrong. So if no one saw that episode, please look at that. The other thing is, you want to know more about NVIDIA, you can go to YouTube and see what Jensen, their founder, said in front of Stanford Business School. Crystal, your brother was in the audience that day because he's still a student there. And NVIDIA is a legal monopoly, and it is going to continue to dominate. I've written many articles that it's a hold through the end of this decade because no one can compete with them.
Now, Dad, one of our subscribers wanted to know why you recommend high alpha stocks when high beta stocks are rising.
Well, that is a conundrum, and so let me try to answer it for everybody. I prefer to buy stocks that zig when the market zags. So I'm proud that I own predominantly high alpha, moderate low beta stocks that often do well when the markets are going down. So there was evidence that Google took NASDAQ down when it fell short of expectations. Amazon did the same thing. And those are higher beta stocks. Meta is a high beta stock. Plantair, PLNR is a high beta. So the higher the beta, usually the lower the alpha, and the less it'll show up in my system. There are exceptions, but I just prefer to own stocks that do well when the world ends. Now, and I prefer monopolies. Now, I want to clarify this. If you get a 5% correction in the market, I can withstand that shock. If we get a 20% correction in the market, they'll throw the baby out with the bathwater and everything will go down. But the main thing is when you own these fundamentally superior high alpha stocks that I recommend, we always know we have earnings to count on, and when the market gets hit, the bad stocks fall like rocks and the good stocks bounce like fresh tennis balls. So I just have a lot of staying power, and I can stick with stocks longer than most people because I'm so confident in what I'm doing in my research. So that's just what I believe. And but there are a lot of very popular high beta stocks that are market leaders. Again, Meta, Plantair are classic examples, and they're not in our portfolio. Those two stocks are not in our portfolios right now.
I think another thing you do, Louis, that's really interesting, always interested me, was your concept of alpha over standard deviation. So not only are you measuring the difference between the alpha and the beta, but you're also measuring how much alpha you get for volatility. Or another way you're saying is, how much risk am I taking to get this alpha? And when that number gets too high, you get out because the ride is too bumpy for the extra alpha that you're getting. So I always thought that was an amazing concept.
Thank you, Jason. That's a great point. So risk to me isn't the angle of a stock's ascent, it's the dispersion. So occasionally we find stocks are going up in a very powerful, steady manner that we don't think are risky, even though they're making new highs. And it's because there's all this institutional buying pressure underneath. There's positive analysis revisions, there's margin expansion, there's all kinds of good things going on. And but eventually, a stock will get more volatile. And in theory, my system might trim it. But you'll find in our portfolios, we tend to hang on these stocks a long time because we don't want to pay the taxes. Our average portfolio, including yours, Crystal, has over 100% embedded capital gains right now. So if I just sold the portfolio out, that's a huge tax hit, even though most of the gains are long term.
One of our subscribers also wanted to know more about dividend stocks and even a smatter of bonds.
Okay, I'm gonna start. I'll let Jason finish. We at the management company, we have a portfolio called Power Portfolio, and we like stocks that double their dividends every 6, 7 years. And we've done a lot of research on this, and we think stocks that double their dividends every 6, 7 years are better than super high dividend stocks. Now, with that said, there's no doubt that drill baby drill is going to fuel natural gas pipelines, other natural gas stocks, and a lot of midstream companies. So that's Hess, that's Kinder Morgan, MXLP is another one we recommend. Now, in the newsletter world, we have this elite dividend list in our growth investor letter. And one of the things people may not know is that when we recommend new stocks each month, those are double A stocks. They get an A in the dividend grader and an A in the stock grader. Those are different databases. And we found that double A stocks are extraordinary. Okay. So we do like those as well because they're fitting both models. And we anticipate picking up a lot of energy stocks as drill baby drill takes off. I mean, our energy secretary, Mr. Kirby, is an expert in fracking. We have our interior guy, Doug Burgum, the North Dakota governor, who's going to be promoting a lot of drilling on federal lands. So it's going to be very, very interesting.
Yeah, I mean, look, I just want to take a minute to discuss. You and I talked for a long time about ETFs and broad market exposure and thematic investing. And one such ETF was DVY, and we wrote a paper about it a couple of years ago where one particular day, the curbs came in, there was forced selling with erroneous quotes, and basically DVY was, I think it was down 38% in a day, and then it closed flat at
34.95.
34.95, and it closed flat during the day. Now, this is for a managed product where there is, a portfolio of stocks to get dividend exposure. It's currently, it yields 3.56, and that might look very attractive. But part of the problem is, Louis, your method is identifying dividend growth, which is just outstanding. So you're basically building a fundamentally superior portfolio of dividend stocks with a growth characteristic in it. Whereas you might, as an investor, get really attracted to high yields in MLPs or REITs or something like that. But if the environment isn't right, you could have serious capital depreciation, which of course makes the dividend yield go up, and it makes it more attractive for other investors until, of course, the stock gets delisted and they don't pay a dividend anymore. So I think it's really important to identify your investments carefully when, seeding a dividend portfolio. And your methodology almost, it doesn't guarantee, but it really increases the odds that you're in the best possible dividend stocks at any given time, just looking at the growth metric alone.
I would add that Wall Street created these lifestyle products. If you're 80 years old, you should be 80% bonds, 20% stocks. And all those failed because when interest rates were rising, it not only hurt bonds, it also hurt some of the higher dividend paying stocks. Now, we seem to be rolling over here where the bond vigilantes, which are mostly people in Europe worried about tariffs and stuff, got our rates up. But you can see here, rates are starting to crack. They cracked after the PPI report, they cracked after the retail sales report. And we do expect rates to decline all this year because Europe's in a recession and their central banks are going to be continuing to cut rates this year. And as global rates come down, it's going to pull our rates down. And a falling rate environment is good not only for bond investments, also for dividend stocks. And the last comment I have is it sure looks like China's the new Japan. Chinese bond yields are lower than Japanese yields. And it looks like China is going to be in a 20-year funk where they have rates at or near zero for 20 plus years because they're having a demographic collapse. They're losing millions of people each year to their population, and it's just really, really hard to grow when you shrink as a society. That's why they have empty cities, and it's very sad.
Now, Jason, one of our subscribers wanted to know what your thoughts are still on Manhattan Associates.
Yeah, this is a stock I used to recommend in a publishing portfolio. We exited similar to the concept we just talked about, alpha over standard deviation. It just got too volatile. It scores a 43 in my system right now, which is a pass. I look for stocks between a 70 and 85, and that's just my method of, taking the whole universe and just focusing on a really small select group of high quality candidates. So Manhattan doesn't fall in that category anymore. So technically this stock is really weak. It's down 23% over the course of the year. It just sold off hard on its last earnings report with a big miss. However, overall, the company has very strong sales and earnings growth, a good profit margin, and strong estimated sales and earnings growth. The real story here is that the growth has slowed down and it's below expectations. So, for this company to start getting its mojo back, it's down, 30% year to date, 23% over the course of the last year. Had a huge sell-off. The stock is still up 134% in the past 5 years. So it really depends on their next earnings cycle, sort of what their forward-looking statements are and if they can get their growth back on track. But for now, the growth story has hit a road bump. We exited the stock before that, so.
And finally, one of our subscribers wanted to know what your thoughts were on Baker Hughes.
Well, their sales are supposed to be up 2.4%. Our earnings supposed to be up 13. Analysts have trimmed estimates slightly, but they have a decent earnings surprise history. I don't have many oil service stocks right now. I think crude oil prices are a bit too low to support this industry, although I'm sure they'll support the natural gas industry as it expands. So this is a stock that might show up on our radar, but we just have to get the analysts more positive near term.
Yeah, I'm still similar. Baker Hughes scores a really nice 81 in my system, but most of that is from recent technical strength. So it looks like the stock could even be a little bit overheated near term. However, it's trading at highs and trending higher. So really on the fundamental side, what I like about this stock is positive sales and earnings growth. 3-year earnings growth is negative. I don't like that. It's got an 11% profit margin and estimated to grow sales and earnings next year. The sales growth is only 3.7%. I like it, but it gets an 81 for sort of the wrong reasons because it's really technically strong. Fundamentally, it has a little bit of room to catch up. But to your point, if analyst estimates or positive comments or a little bit more expanding margins, is going to pop this fundamental score right up into my sweet zone. So it's just outside.
Now, the biggest news next week will likely be the Fed's FOMC minutes. What do you guys expect from that?
Well, we want to see how much they're agreeing with each other. What we're really looking for is disagreement, because not this last Fed meeting, but the one before, they definitely were disagreeing when they had a dot plot announced as well. So that's really what we want to see. And, the Bank of England right now has severe disagreement on their board, and they can't seem to agree on anything. So the more disagreement we get, the more interesting the minutes will be.
Yeah, it's interesting. I'm focused on that dot plot as well. And I think last week, in a prior episode, we went over a chart that I shared that showed the market's expectations of Fed funds rate versus the actual Fed funds rate. And in that chart, and we'll supply it again, you can see the dot plot, the FOMC dot plot forecast rates falling down. So the market is expecting rates to go down and then back up. But interestingly enough, they have nearly 100% history of getting it wrong. So the market's usually wrong about where rates go, and the market is ignoring the dot plot. So I'm really focused on this dot plot. Yes, we want to see consensus, but ultimately, I'm with you, Louis. I'm in the camp of more cuts this year than everybody's expecting, which could be significantly bullish for the market. And as the market's usually getting it wrong, I like our chances.
By the way, yeah, Neil Kashkari, the Minneapolis Fed president, came out and said that he expects the rates to be lower later this year. I wrote a Market Watch editorial piece where I said that I recommend that Trump appoint Neil to be the next Fed chairman because, Jerome Powell's a lame duck. And Neil's very experienced. He also ran the TARP program under Hank Paulson, a former Treasury Secretary. So I placed my bets for the next Fed chairman. It's not going to be Powell. He's a lame duck.
So the call with Trump and Putin seemed quite monumental. Is this hopefully an end to the war in Ukraine?
It's the start of ending the war. Negotiations commenced immediately. Trump and Putin are supposed to meet in Saudi Arabia to officially end the war. Obviously, they're working out all the details now. Our European allies were aghast that they were not included in this, but I don't think Trump really respects them. There is going to be some difference. Trump has already mentioned that Ukraine could be part of Russia one day. Okay, that's not what they say in Europe. Okay, in fact, Britain has declared they have a 100-year partnership with the Ukraine. So. It's interesting to watch. Basically, Trump just muscle his way. Also, Trump said after Saudi Arabia, Putin may come to America and be against the White House, and Trump may also go to Russia. So Trump is trying to get Russia, U.S., and China all together and basically create another alliance that's probably going to have Europe really rattled.
Yeah, that's a really interesting point you have there because the key to China right now is actually Russia because Russia is so closely aligned. Love or loathe Donald Trump, it is clear that he is trying to deliver on what he said he would do, making bold statements about Israel, Gaza, proposing US buy Canada, all these things that seem silly in the headlines. And then he goes and does something like has a call with Putin, says we're going to start negotiating immediately. So I will say this. Could it be the end of the war, the beginning of the end of the war? Yes, it could. But odds are stronger for this than what the prior administration with an adversarial position in supporting Ukraine, that's gone. So removing some of these headwinds and trying to achieve peace on the superpower front is a pretty big deal. And then trying to quell Middle East peace, Middle East, turmoil at the same time. He met with the president of Jordan and he's out there. So I would be leaning towards, yeah.
And finally, can we talk about the tariffs?
Sure. Well, you might notice when Trump announces the tariffs, there's a waiting period. So on Thursday, he announced reciprocal tariffs kicking in 180 days, and that got a big pushback from the European Commission, which is the head of the EU in Brussels. And specifically, Commerce Secretary Howard Lutnick, who should be confirmed soon, will be assessing the tariffs on each country and suggesting remedies. So just to be clear, when we import a car from Europe, the EU, there's a 2.5% tariff. When we ship a car to Europe, they put a 10% tariff on, and when we ship an SUV to Europe, there's a 25% tariff. So either Europe's going to have to go down to 2.5%, or we're going to go up to 10 and 25. So this is going to be very, very interesting. And Trump's ultimate goal is to onshore a lot of manufacturing in America because our energy is a lot cheaper. So, Jason, you work for Howard Lutnick. I think he's going to be having fun with this.
I think he is. I don't know if you caught this little thing during there was a press conference the other day from the Oval Office, and they were talking about, Elon Musk on his Doge page in Twitter or X said, should we investigate the IRS? And obviously there was an overwhelming response for yes. Trump was addressing that. And he was like, well, I don't know if we're going to close the IRS. And you hear in the background Howard Lutnick saying, not yet, not yet. Someday, I think is what he said, actually.
Yeah.
The point of this, sorry, go ahead.
I want to be clear. Howard really thinks we can get rid of the IRS with tariffs because that's what we used to do. And he keeps harping on that. And that's a radical position, but I got to give him credit for sticking to his position.
Yeah, the only reason I bring up that position is because when we're talking about tariffs, initially I was thinking, oh, these are just negotiation tactics and, it's a lot of chest thumping. But the more I think about it and all of Trump's actions, whether it's in regard to Gaza, whether it's in regard to, imposing tariffs and seeing countries' reactions, whether it's, calling Putin, all these things, Doge, the deep delve into the government inefficiencies, it seems clear that he means business. So are these negotiating tactics? Yes, but if Trump doesn't get what he wants, I think they will all go into effect, and it will have potential effects on our relations with other countries. But in the end, there's debate over whether these tariffs are going to be harmful to the American consumer or helpful, but all of these tactics are designed about his whole America First agenda. So it'll be really interesting to see, but I do think he means business.
What's interesting is Trump, has a golf course in Ireland and a resort, and he praised the Irish officials and the government there, but he loathed Brussels and the EU. And so they are definitely taking shots at the EU. J.D. Vance just gave a speech in Munich where he basically chastised European leaders for censorship, especially on social media. If you post the wrong thing in Britain, you can have up to 7 years in jail. And he really chastised Germany because Germany has an election on the 23rd. And their AfD party, which is led by a Goldman Sachs gal, Alice, she wants to restart the nuclear plants, and she's more of a libertarian. But the other German parties basically said they're not going to work with Alice and AfD, and that's ridiculous because they're going to get possibly the biggest share of the votes. So JD Vance just rattled everybody too. So and Marco Rubio was headed there, but he had to turn the plane around. So hopefully they fix Marco Rubio's plane. So it's not just Trump. It's the whole administration's kind of hitting the reset button, and our European allies are aghast right now.
Well, thank you so much to you both for answering all my questions. Once again, thank you all so much for watching, commenting, liking, and subscribing. We really appreciate all your support. If you missed it last week, Louis just had a book launch, so if you want to purchase it, it'll be in the description below. But until then, we will see you all next week to discuss a new round of stocks for their earning announcement season. Thank Thank you so much, everyone.